We are most certainly going to now continue to see weak growth numbers well below what is considered potential output. While there could be some supply side driven inflation, I don't think anybody thinks that's going to be a concern at a broader level. There is going to be pressure on the MPC to keep cutting interest rates. We're at 4.4% repo rate, well above, sort of zero lower bound. But how low do you think rates can go in India, and what are the constraints? Things like small savings, the fact that a lot of Indians depend on deposits. Will all of those constrain the lower bound of rates in India?
That's a very good question, Ira. And one of the points you made is that you need to have reasonable interest rates for depositors, since almost all the bank liabilities come from deposits, and therefore you need to keep up those deposits and hence sort of mildly positive real interest rates. So I think that it would not be particularly useful for the MPC to keep reducing the policy interest rate. Let me just remind you that in 2009, we had actually gone down to 3.25% reverse repo rate. And yet lending rates hadn't fallen much below 8-9% at that time. In fact, if I remember correctly, they remained near 10%. We are seeing the same phenomenon now, that despite the reduction in the policy rates, repo and of course now reverse repo as well, that the market 10-year bond yields haven't gone much below 6% to thereabouts. It's about 6.1 or so, isn't it? The 10-year bond yield still?
About 6.15 on the 10-year, sir.
Yeah, 6.15. Yeah. So that's what I'm saying. So that is telling you that it's not particularly useful to reduce policy rates much further, because they won't affect lending rates very much. So I actually have, in some sense, an out-of-the-box suggestion, which I had also made, by the way, in 2008-9, but it was not accepted then either. My suggestion essentially is that what is it you want? You want borrowers in the country in these difficult times, small, medium, and large, to get the benefit of lower interest rates. That would also reduce the risk aversion of the banks. And at the same time, you want to keep up interest rates in the interest of depositors, so that they keep their deposits in the banks, they don't get too nervous, etc. So I think that the solution, very easy solution, is that once again, the government should offer a 2 to 3% interest rate subsidy across the board for lending over a fixed limited period of time. Could be 3 months, could be 6 months, could be even 1 year. That's a pretty cheap thing to do if that helps in actually getting lending moving. Because just think of this, that 100,000 crore of lending would just mean a cost of 2,000 or 3,000 crores, depending on the interest rate subsidy. So to my mind, it is better to keep the financial system functioning as well as you can keep it making functioning, to keep the financial markets functioning, for interest rate price discovery to keep happening, while achieving the objectives that you want, which is higher lending to keep the economy going, to make it recover quickly as the lockdown gets eased and is lifted, so you're sort of addressing different problems at the same time.
So you're suggesting, Dr. Mohan, that, for instance, we do interest subvention for crop loans, etc. You take that same principle and do it for a wider set of corporations. Did I get that right?
Yes, I do it across. Don't choose. Just do it across the board. Whether it's for retail, whether it's for large companies, small companies, whatever, for a fixed limited period of time.